So hopefully some of you are aware of HLB Mann, Judd. So certainly we had the opportunity to talk to your group. So we're a mid-tier accounting firm. So we're HLB Mann, Judd, technically NSW, or there is a Wollongong firm as well. So we essentially cover the Sydney region, but there's also HLB Mann, Judd firms in the other capital cities. So we pretty much cover the country. But HLB International, which is quite pertinent to today's topic. HLB International is pretty much in all over the world. So often have worked together with colleagues in other countries, and sort of we find that, in fact, a lot of our HLB community members, the firms that we deal with, sometimes what they're looking for is, I've got a client that's doing something in Japan. They could use a referral to a Japanese accountant, and so we'll help sort of facilitate that. And sometimes there's things we work together. Sometimes it's just they just need that overseas connection. So there's a whole range of things that we do, and Tony he might just talk briefly about that, and then we'll get into the actual content of the presentation. So that's me. I'm partner in our tax division. Pretty much cover the range of taxes. Mostly, we tend to stream a lot of our services in either corporate or private area these days. So I do have a number of corporate multinational sort of clients, but a lot of my focus is in the private and SME space. So that's certainly where the expats certainly fits in with that. So that's where I do a lot of work. And I've had my whole career with Mann Judd. So started fresh out of school 31 years ago. So still with the firm. I've been a partner for 17 years now. The HLB community is something we established a few years ago. We've always had relationships with accounting firms, and we try and mutual relationships. We find there's some referral that can be done both ways. Tony, as I said, works with us and really sort of fosters these sort of relationships with other firms that we know. So
my primary role at HLB Mann Judd is to manage the community of metropolitan accounting firms, most of whom are either sole practitioners or 3 to 4, 5, 6 partners. And the community's grown significantly over the last couple of years, and we've become an important partner to these small firms. Our partners and our teams, like Peter and his team and several of our other partners, work alongside myself to provide the appropriate technical and networking support to the community members, to the firms and their clients. It's all about supporting the member firms' clients, really, at the end of the day, to help you deliver the services they need that might fall outside your sort of area of expertise. So we've got an old-fashioned approach to customer service. You'll find us very approachable. There's no gatekeepers. If you need to get any information or find out anything, you can come through me or directly to people like Peter once you get to know them, and you'll get a response very, very quickly. There's no cost to become a community member. We've got about 100 firms at the moment. On becoming a community member, you get access to all of our technical publications, obviously access to Peter and the other partners, and networking events and webinars and whatnot. So it's proven to be very successful, and I'm more than happy post this evening's presentation if any of you want to touch base to me, I'll send out a brochure with my contact details, and if any of you want to contact me directly to learn a bit more about what we can do to support you in delivering great service to your clients, I'm only too happy. I'm available anytime you need to talk to me.
The residency tests for individuals have been in place for many years. 4 tests, and I won't go through each of the 4 tests because I think that's certainly one of them relating to Commonwealth superannuation is a bit less common. But certainly, 183-day test is obviously relevant, but in practical experience, and I'm only talking more about outbound. Typically, when someone comes into the country, it's fairly common that they'll become a resident, and unless they're only here for a very short time. And if they come on a temporary visa, like your common sort of 482 sponsored visas, which used to be the 457 visas, which probably people are reasonably familiar with. Obviously that will then you get into temporary resident exemption rules, and I'm not proposing to cover any of that necessarily today. So I'm focusing more on the outbound side of things. So when somebody leaves Australia, it's usually this concept of where do they reside, the permanent place of abode tests, and there's been a number of recent cases about that. And I think it was noted when I can't remember the exact stats, but when the budget changes, I know that the Tax Institute in their summary of the May budget provided useful observation about how when the exemption and for foreign employment income in 23 AG was removed back in 2009, this became so much more important issue, because previously you could be working overseas, you could be you might still be a resident, but if as long as your employment income was exempt, then it really, for most people, that was their biggest issue. So the observation the Tax Institute made was that when that exemption was removed in the 10 years, like there was a very small number of cases up until 2009, and in the 10 years, say 10 years from 2009 to 2019, when Harding's case was finalised, there was something like 50 or 60 cases that went through the sort of federal court, high court level, all on maybe that included AET cases perhaps, but all on the question of residency, because a lot of people were arguing that they were non-residents, because if they were resident, then their employment income would have been subject to Australian tax. So whereas previously that wasn't such an issue. So it's the whole issue of establishing residency, and the classic would be somebody who goes to, in fact, Harding, Harding was in the, you had older cases like Applegate, which established some of the general principles, things like, roughly something like a two-year time frame that you'd have to go to. Say, that's what I always think of when having conversations with people about these sorts of issues, that if you're not going for something like, if you're not moving overseas for at least, say, 2 to 3 years, then you're probably going to struggle to establish a non-residency, although it is quite subjective. So the tests depend on a whole lot of things like business and employment factors, ties, family, social factors. So it's a very, and I'm sure a lot of you again are familiar with these general concepts, but it can be quite subjective. But the ATO's rule of thumb, certainly coming from cases like Applegate, where that if you're not going for more than 2 to 3 years, then at least 2 to 3 years, then it becomes difficult. And then Harding's case was sort of one that certainly tested that sort of principle in 2019, and he was in the Middle East, so that would be a classic case where naturally somebody wants to be a non-resident because they're not going to be taxed. If they're a non-resident and they're working in the Middle East, they're not going to pay any tax on their salary. So obviously that makes a huge difference to their position. And again, you're probably aware of Harding's case, but it was quite a significant one. Is that Mr. Harding's argument? He was an aircraft engineer working for one of the airlines there. His argument was, well, I'm in sort of serviced accommodation type thing, but I've definitely settled in Saudi Arabia, I think it was, for example. And the ATO's sort of counter argument was, well, you're in temporary type accommodation. You've lived in a couple of different places within Saudi Arabia or within the area that you're working in. You haven't really got a permanent home as such, and they focused on the actual dwelling itself, and so that went all the way up to the High Court. And the finding was, well, no, you don't. It's not so much the dwelling; it's the fact that he's found a home. He's got a home in Saudi Arabia. He's really settled there. It might have lived in a couple of different dwellings, but he really has settled there. And that was quite an important decision. And then so they're positive cases where people positive from a taxpayer's perspective in that they can establish a change of residency. There's a couple of other, this AET case that I mentioned there for 2013, that was where the one that the taxpayer lost. There's some rulings, the older ruling, IT 2650, which of course, typically with the older rulings, they're quite brief. The more recent rulings, as you know, a lot more detailed. So TR 9817 is a much more detailed analysis of the residency of the residency tests, and can go through various examples. And so that's I guess establishing the tax residency position as it is. And then of course you've also got to consider DTAs. And I've certainly had recent experience talking to a client of an HLB community member who's currently over in Italy, and he's been there for a period of time actually, but the client himself had actually done quite a bit of research. He's worried about the Italian tax position. This is a good example of where I get to a position where someone will sometimes come to me looking for guidance on, and they need to sort of think about both sides. And we can advise them on the Australian position, as you probably find you probably do with your clients from time to time. But then there comes a point where, like as in this case, he needs to talk to somebody in Italy. There's one of our HLB firms. I've got a tax partner in a firm, and in one of the HLB firms in Italy who he can talk to. I don't think he's actually sought that advice as yet, but I'd suggested that if he really wants to get the Italian position sorted, he really will need to talk to them, because apparently supposedly the Italian tax authorities are quite punitive in the way they approach things. So that's a situation where he actually wants to establish himself as a resident, because I guess the tax consequences in his case in Italy are worse than in Australia. So he wants to show that he's a resident, and part of it is establishing, firstly, that he's resident under the Australian tax law. Now, the Italian tax authorities may also say that he's a resident, and that's when you come to the double tax agreement. And you've got to then look at there's a number of tiebreaker provisions in the double tax agreements. There may be differences, but they're broadly similar in they're all generally based on the OECD model. And so that's a case of in that particular example, he's got to firstly establish that yes, he is a resident, which the ATO should probably, generally they are on the side of saying somebody's a resident, but he does still need to look at the facts and does still need to make sense. And then he's got to go to the level of saying, well, is he does the double tax agreement allow a tie break in favour of Australia? So that's his. So I haven't really got an outcome on that position, but it's one that's been in recent months. It's come across my desk, and it's something that certainly is. It shows you the different areas, and what he did. One thing he did, which I guess is of interest, is that he went on the ATO website, and there is a residency questionnaire or sort of tool that you can use there, and he went and filled it in, and what he found in changing a couple of the answers to questions is that his factors were so close that it swung on how many times he came to Australia. For example, if he came, say, twice, if he visited Australia twice a year, that the questionnaire or the checklist came back with an answer saying, well, on balance, you're a resident. If he only came once a year, it said he's a non-resident. I know he has been in Italy for sort of 4 or 5 years, so that probably would be a factor there as well. But so it's a very subjective test. Okay, so this new resident, as I said, residency is one that you can spend a lot of time on. So I'll try and keep moving through the rest of it a bit more quickly. But none of this is law yet. It hasn't started, so I'll try not to spend too much time on it. But just to you would have probably seen the announcement. It's on the face of it, it's a welcome announcement that we're going to make the tax residency rules less subjective, easy to apply, question whether this started from a border taxation report a couple of years ago, and the government has now picked up on it and said, yes, we'll look to introduce something like this. Question whether, really, the proof's going to be in the pudding, how they implement it and how they legislate it, as to whether it really achieves that. One key element is to have a 183-day bright line test, as they call it. So on the face of it, if you're in Australia within 183 days, previously there could have been you could have still had a usual place of abode overseas, and it could still have fallen outside of it. But they're going to say, well, if you meet the 183-day test, you're a resident straight up. So that would make it easier. Then it gets a bit more complicated, because they're going to have certainly the border taxation report. It's less clear what the budget announcement is intended to achieve, and how closely that will follow the government and the border taxation report. But when you look at what the border taxation proposed, they were talking about things like a continuing resident test and a commencing resident test. So depending on whether you're coming and going, the tests will be applied differently. Overall, the best thing to say is about this is that it's going to be harder for people to break residency and to remain a non-resident. And so you have to think that's probably deliberate. They want to reduce the opportunities for people to break residency. There are 4 specified factors that are similar to the tests that were established under the case law relating to the resides test, but these will be they actually set out in the legislation. So if someone has the right to be in Australia permanently, which I categorise as being they're either Australian citizen or they've got permanent residency, that's one tick. That's one factor. So if you're an Aussie, you're going to tick that one straight up. If they have Australian accommodation available to them, and then some of the examples you hear of are things like if they own their home, but then they've rented it out, that's not available to them because they've got tenants in there. They can't kick the tenants out, come and use it whenever they like. But one example I've heard is someone has, like a granny flat in their sister's backyard or something, so that which is sort of available to them. It's not being occupied. So if they want to come back and visit, they can stay there and store their belongings, whatever. So there's different things where there could be accommodation available to them, or if they have multiple properties and they can afford not to rent one of them out, or they, there's various scenarios. Another third factor is if there's Australian family ties, And the fourth factor is Australian economic ties. So the case law has things like social ties and other sort of ties, but I guess the border taxation have narrowed that down to simply family and economic, the two key ones that they see. So what would get into, if you're in Australia, again, there's another differentiator. It's proposed that if they're in Australia, less than 45 days, then the test will apply differently. And there's a bit of the border taxation set out a bit of a flow chart. It's the sort of thing that's best. I don't want to go into that much detail in this presentation, but it's probably best when this is implemented, it'll be best understood probably by a flow chart, so you can see it more easily. But if you're less than 45 days, and that is a discussion I had with one expat who's I'd advised when he moved from Australia to Malaysia, and then he clearly broke residency at that point. Now he's got another position in the UAE, which he's going to move to, and he's concerned that if this definition comes in and he enters into those new arrangements, how will that impact him? And it's going to probably boil down to he'll probably meet a number of these factors here, and if you become subject to them, you've only got to meet 2 out of the 4. So if you're an Australian citizen, you already meet one of them, so you've only got to meet one of the other 3. And so it's a good chance people that are subject to these factor tests will meet the 2 out of the 4 fairly easily. If in that particular example, if he doesn't come from, say, he only gets his 4 weeks off a year or something, so when he comes back to visit once a year, he only comes for 30 days or something, or 4 weeks, he'll be less than 45 days, so it'll be a lot easier for him. But if he was to come for 6 weeks or something, then or more, then it's probably more than 45 days, and it starts to become a bit more difficult. So anyway, that's the thing. So to finish off this point, these new tests are less subjective, that's true, but they're more complex. And so I think there's still going to be a bit of unraveling once we get these new rules and get our heads around them, and try and advise clients on how they actually apply to their situation. And the tiebreaker will still apply. So we could determine whether someone's a resident for Australia, and then you'll still have that situation, like I mentioned with the guy in Italy, where the Italians also want to treat him as a resident, and then you've got to apply the double tax agreement tiebreakers, which won't change to see where it falls down. And so if passed, this will apply from 1 July after Royal Assent. So it's pretty likely when budget was announced and came that there was no legislation going to come before 30 June. So now that we've ticked over into the new financial year, at the earliest it can apply for next financial year. Who knows how high this is up the government's priority scale, or whether there's going to be consultation further before it gets implemented. So we'll just have to keep a watch on that one. In the meantime, we keep following the old rules. So I'll just move on now. Yeah, CGT Main Residence, as we just touched on before, it's a very, very key concession, but you would have lots of problems given that exemption that the rules were passed in 2019 and with effect certainly from 30 June. Any disposed after 30 June 2020 is now very much so. Any sales that take place now are subject to these new rules, which can be quite punitive. Again, as I think you're probably already aware, that it effectively takes away the benefit of the 6-year absence rule, which was huge for the expats who went overseas for, say, 4 years or something. That was the best scenario was someone who, moved out of their home, went overseas for less than 6 years, came back, they could rent it out the whole time they were away, and they just moved back in, and it's like they could either sell if they wanted to, or they could move back in, and because of the 6-year absence rule, it's like they never left. So they could potentially get the full main residence exemption when they eventually sell. So that was obviously the great scenario. I've had clients who sold after 6 years, and then they still get the benefit of the 6 years, like sold after 7, they only have to pay tax on. They start with, they get the cost base at the date they move out, which would be generally when they move overseas, and then market value, and then you've got 7 years, so you only pay tax on 1/7 of the gain, no discount. That's something obviously to be aware of, but still, if you're only paying tax on a very small gain, it's less of a concern. And as I said, their market value cost base often. Section 118, 192, when you move out, as long as something's been your main residence since you moved. Since the key to that is that it's always been their family, their home, and then when they first move it, the first time they move out is when they go overseas. Then it works. The 6-year absence rule and the market value cost base working well together in those situations. Where there is CGT payable, you've got no CGT discount for non-residency days. So anyone going overseas now or who's gone overseas since 2012, they won't get any CGT discount for that period. and it can get quite complicated if either they have, even if they don't have non-residency days before, they haven't been overseas before 2012. If they come back and then it's still a rental property, or there's still CGT for a period before they sell, after they come back, then you can still end up doing a pro rata calculation. But any discount that could be available can only be available for the period, the residency days. So days when they were back in Australia, not when they were non-resident overseas. So the best thing is to avoid that sort of pro-rataing of the discount, and but if you need to, then it's certainly still much more limited. Unlike the 6-year exemption, you can't undo the benefit of the the detriment of being overseas and then losing part of the discount. And again, like someone said before, you might have said it, Peter, before, that there's an easy or an easy target, expats or one, and that's people overseas who think, well, they're not, and there's always the view, and there were different views on this change. Some said it was outrageous. Others said, well, they've gone overseas. They're not, they're not paying taxes in Australia. They're not sort of, they've decided to move overseas, so why should they get the benefit of these exemptions? So it's a bit of a philosophical argument there, but it's I think it's pretty outrageous personally. But
it's certainly very, it adds up very quickly when you start doing these calculations, as you well know. And the discount was in place of the old method of indexation. There's been no allowance for that.
Absolutely. So,
So
look, so the discount for is bad enough, particularly with property. Obviously, with financial, and I'll talk later about financial assets. As you probably know, it's not so bad with financial assets with non-residents, but certainly property. And I've had, when you're not talking main residence, you're just talking generally property. The loss of the discount can be pretty significant. So I'll just move on to talk a bit more about this thing, and so then I guess just goes through a little bit more about this loss of the exemption. So and the thing, it was alluded to before, that I really thought this measure was gone pre-election, because it seemed to be dropped in the lead up to the election. I guess they probably figured they weren't going to get back in, and anyway, and it didn't seem like it was going to happen. I had one lady, a client that was actually, she became a client when she was already living in London, but when she was visiting back here, she realised she needed some advice, and became a client too. And we also were able to assist her in the UK as well with her taxes, but with our affiliate there, she was right onto this. She was keeping an eye on it. She was checking it with us for updates, and at one point we said to her, well, I think you're okay. It looks like this is dead now. But unfortunately, it came back, and then it got passed pretty quickly in the end. It's there. So fortunately, the date got pushed out a little bit, but still 30 June 2020 was the date. So now we're past that. Anything that happens is going to be a problem. And I guess the key is that if we've got non-residents who are overseas with properties, one curious thing is if they come back, it's like this rule never happened. They may still be, if they exceed the 6-year period, they may still lose some of their discount. But this rule won't apply to them, because it only applies to sales by non-residents. So if they become a resident again before they sell, now of course you've got to become a resident. You could come back and sell. You could move back here and sell straight away. What you can't do is move back, sell, and then go overseas again. I mean, that wouldn't work. That wouldn't cut it. But it's got to be a genuine change of residency. But that would work. So that's part of the planning. People should be But if they're expats that are not coming, especially in COVID, I mean, you read stories about people who say, well, why would I? I read something in the paper the other day about someone who's saying, well, I'm happy, I'm living in Europe, I'm not coming back in a hurry because Australia isn't going to let me back in. We're all vaccinated, we can travel around Europe. I'm looking at what you guys are doing, so why would I come back? So there's people like that are long-term expats, overseas expats, probably thousands of them, many thousands of them. They may feel they have to sell. Like the right thing to do is to sell, and I can't necessarily you can't plan all your decisions around tax, and but they've certainly got to factor in how much taxes are going to cost them to make a sale. Whereas if it is someone who's going for a few years and they can hold on to the property until they come back, that should work out better for them. So that's something we've got to consider.
It's almost like actually a retrospective tax, although it's not. But there would have been a lot of people plan to move overseas potentially.
Totally, yeah.
Knowing, look, we'll get our main residence exemption, and then maybe the 6-year rule, we might come back. and planned it that way. So
Totally, yeah.
It's definitely pretty much a retrospective tax.
Yeah, especially when you consider this second last top point here, that there's no pro rata or deemed cost. Like the fact that the fact that there could be no deemed market value cost base is beyond me. Why that can't be in there? Because there's so I'll then go into this example. This came out of an article that I wrote on this area, that say we have a couple that moved over to Singapore. They buy a house for 600,000. It have to be a while ago now in Sydney, but then worth 2 million in 2018 when they go overseas. They sell it while they're still overseas in 2027. 3.5. Assume that's realistic value. Previously, they would have they're over the 6-year period, but they would have been able to do a pro rata, so they would have still got something. And I haven't checked these numbers, but if these have been transposed correctly from when I did this originally, these tax rates might be slightly outdated too. But the taxable capital gain should be 462 on a pro rata basis, even with no discount. And so you've got to take a couple $100,000 of tax. So I think people can cop that. I think we've done quite well out of that property. But on this rule, you've got go back to the original purchase of cost of 600,000. No allowance for the 18 years that they lived in the house, which is just ridiculous. No market value, which would have easily been solved by a market value cost base. So you end up with a $2.9 million taxable capital gain, no discount. You've got tax of up to $1.3 million. It's just so another $1 million of plus of tax on top of that. So that's just those numbers might be a little bit extreme for most situations, but it certainly is that is a potential outcome given the right facts.
So people with that outcome.
Yeah, there will be, and there probably are worse outcomes. I tried to make something reasonably extreme, but also realistic. That's the implications, but that's like we said before, it's an easy target. So that's what's been done. So I'll just move through some of the other points. So with investment properties, there's a couple of points with investment. Obviously rental, something that is overlooked. I've seen this many times. People don't have anything else that's taxable in Australia. They're clearly non-residents. They don't have, they've got salary. Most of their income comes from salary. They might have some financial investments, which I'll touch on in a minute. So, they're not, no tax. They've got foreign income's not going to be taxed. Foreign, dividends and interest is not going to be taxed, even if there's frank dividends on Australia, on Aussie shares, they're not going to have withholding tax. So maybe some interest, they might have a bit of withholding tax, but it's not significant. So they don't really have to, they probably, in most cases, won't even have to lodge an Australian tax return, except for the fact that they've got they own a rental, they own a property. And it could be their former family home, or it could be an actual investment property that they acquired. The number of times people that I've seen just not think that they need to lodge a tax return, or haven't lodged a tax return for the last 12 years that have been out of the country. And if they haven't lodged a tax return, they haven't been assessed. So there's no limitation on the ATO assessing them if they were to choose to. So, but just people being aware that they should be declaring the net rent. Now, it could be a loss, of course, if it's negatively geared, but certainly, and there's nothing stopping them carrying that loss forward, particularly if there'll be a capital gain in the future. So that again, there's an incentive. There's actually a good reason to declare the loss and accumulate it, so you kept a track of it all. But if it's a profit at non-resident rates, there is tax payable, subject to foreign tax credits. Generally not, and it's because net rental income is not generally excluded under DTAs. So generally, you would need to include it in both countries and get foreign tax credit relief, at least in one country or the other, so to avoid double tax. So it's just something people need to be aware of and need to disclose. That's the main point I'd make there. As we've already covered, no CGT discount after 2012, so that could be pretty punitive. And this is where I've had people come back from overseas and they've had some investment units. They've had sold a farm for actually up Tamworth way. They've sold a farm for a few quite large capital gains, and then you've got to pro rata that for non-resident days, and they lose part of their discount. So you've got to sort of consider all of that. A couple of other things to note with rental properties. I mean, this is all stuff with a lot of rent with any properties. No deduction for travel expenses. Had the question. So I'm flying back from London to I'm going to go visit my rental property. It's like, well, obviously you can't claim your airfare for especially if the trip happens to be around Christmas time. But this was before this prohibition, so that you could probably, if you had to take a taxi out to actually specifically to visit the property, then maybe that's reasonable. But because this was being abused, as probably aware, the government has just said no, there's no deduction for travel expenses to inspect rental properties. I mean, most people have an agent, so do they really need to go out and change a light bulb or have a look at the property when you're paying an agent to do that sort of stuff, or not to organise that sort of stuff? So it's so they just got rid of that completely. Obviously, getting a QS report for any Division 43 or Division 40 claims always important with investment properties, but often overlooked. So that's a more general point. Vacant periods, so particularly when they're when they're overseas, making sure the property is actively being available for rent and being marketed for sort of rental. So just got to be careful that you're doing the right thing there and not leave themselves exposed. And if properties are used by family and friends, adult children, that sort of thing, just making sure that you charge some sort of arm's length rent, even if it's just to cover, it may be just to cover expenses but probably should be, ideally should be something approaching an arm's length rent to justify claiming deductions against that. Okay, so financial investments, the main points I guess to address here is, unlike property, as you know, unlike Australian real estate, they're not taxable. So shares, managed funds, and things like that are not cryptocurrencies, things like that they're not taxable Australian property. So you'll get a deemed disposal. Technically, that is an election that can be made. So people could choose not to have deemed disposal and then leave those assets in the Australian CGT net, but I haven't really seen too many situations where that would be done. So if you want to make sure that's not done, you best document that that's the choice. But including having a deemed disposal means there's most likely a capital gain or loss that should be included in the tax return in the year of ceasing residency. So that should ideally be done, and that would be certainly evidence that they've taken that choice. And by the same token, not declare, if there's a capital gain and they haven't declared it, that might be an assumption, a presumption. The ATO might take the assumption that you've chosen not to take a deemed disposal. So your share portfolio that you had when you left Australia, you come back, we're going to assume that you you made the decision to leave it in the Australian CGT system. So the large gain that accrued while you were overseas is going to be taxable. So ideally you would want to, again, might depend a little bit on what happens in the other country and where they're going, obviously, but generally most people would be probably advised to take that deemed disposal, and then they don't have to do anything with it. And then the other side of the coin is when they come back, or if it's somebody who's moving, it's somebody overseas who's actually moving to Australia because they've never lived in Australia before and taking up permanent residency. So again, I'll ignore the temporary resident rules, just say that they've got permanent resident status. So they're just becoming a resident straight up, or they were a temporary resident and now they're becoming a permanent resident. So they'll get that deemed acquisition at market value. So again, and probably one example of that, I've got an elderly retired client who I only started acting for him when he came back from Australia, but he's 87 now. So I think I've been acting for him for about 11 years or so, but when 11 or maybe 12 now, but when he had 16 years over in living in the UK, has a whole lot of shares and basically lives off gets a good return off his share portfolio. So he has very diligently recorded the market values of all of his investments when he came back to Australia, and the foreign exchange rates of the cash that he was holding, so that he can he's aware of it, keep track of any sort of forency, which actually is my fourth point on this slide about forex movements. So that guy has got good records, but that's the sort of thing you need to do, so that when they make those sales, and I'm always talking, he's got some, and that guy's a good example too, because he's got some. When we look at it from a CGT perspective, he's got some loss positions. He's got carry forward capital losses, and he's also got some other unrealized loss positions. And he's always saying to me, well, but even though my Westpac shares look like I'm making a loss, in reality, I got them for $2 and I'm still sitting on a big gain. So, but he understands that there's a CGT aspect as opposed to the commercial aspect of so in the end they're going to they might still do well out of those investments, but obviously what we're concerned about is what are they ultimately going to be taxed on. So and particularly for people who moved to Australia, then they might have a whole various investments that they hold, foreign investments. So you just got to keep track of those cost bases. And the Forex movements, Forex is important because, again, a lot of people don't realise that when they come back to Australia, if they're holding large amounts of foreign currency, the foreign currency you get foreign FX gains and losses on revenue account. And I've had clients that have been stung where they took out, had some cash, held onto it for a little while, took a big amount out to then buy a house or something. And I guess in a sense it's gone in their favour because they've made a big gain. So the currency has moved in their favour, but it's what they weren't expecting is a big tax bill on the fact that they made an FX gain over a number of months or a couple of years. So, but it's something you need to keep track of anyway. And withholding tax, again, as I touched on earlier, if people are overseas, not an issue for franked dividends, but for anything that's unfranked or interest, they will suffer withholding tax. But at least they'll be able to claim that withholding tax they should be able to claim that withholding tax in their other country, except if they're working in the Middle East and they're not paying tax. Then obviously the withholding tax is the tax cost. But I think people in that situation are pretty happy just to suffer the withholding tax and leave it at that. So that's probably with financial investments, and they're much more straightforward. A lot of those property issues where things really become tricky. Actually, superannuation, and I've gone as far as putting Andrew Yee. Andrew is a director in our superannuation in our wealth management division. So it's superannuation cross-border is a very complex area, but it's something that does need to be managed. And I suppose the first point I'll note there is that when people are overseas for an extended period of time, it does restrict their ability to build up Australian super, unless they're sort of putting money away in Australian super. But generally, they're particularly executives on big sort of packages working in somewhere like the US or the UK or something like that. They'll be building up. I mean, US is, as with everything, is a pretty complex system to deal with, and so people will build up. But Aussie expats, executives who've built up quite significant values, they have their the various different types of 401k plans and all sorts of other acronyms for different types of retirement savings and pension savings accounts in the US. So they might be building up money there, but when they're doing that, they're not building up money in Australian super, which is, as we all know, is an extremely tax-effective place to have your money. So if they're going to ultimately retire back in Australia, one issue they'll face is what do they do when they come back here? How do they might be a bit behind on, given the level of wealth, that some of those executives probably have, and depending on how old they are, they probably have a bit of catching up to do in terms of really getting more money, pumping more money into their Australian super funds to build it up for when they retire. It's just something they need to be conscious of. There are some countries we have, like the US, we have reciprocal agreements with, so exempting, and what they typically will do is exempting them from a local super pension. So if someone's going to the US, they can give a certificate of coverage. So essentially they're paying into Australian super, not in the US super, and the other way. So it's often someone on a temporary assignment also, so that if there's someone coming from the US to here, they may not have to necessarily pay into Australian super if they're covered in the US. So, but it's something that would be a certificate they get from, in that case, that's the certificate they get from the IRS. Or if it's someone going overseas, they get it from the ATO. So not every country has that, but in the US is one that we'll use as one that we have that agreement with. So SMSFs, that just extends on the previous point. I mean, definitely careful planning in people going both ways. I mean, in terms of, again, I'm focusing a bit more on outbound expats, but certainly when Americans come here, the IRS just takes a very dim view of Australian super and SMSFs in particular. They view them like a controlled trust, and they can create all sorts of problems in terms of reporting in the US tax returns. But for people going overseas, I suppose it comes back to that point about just being careful. You've got to be often you would have. I know you can be an individual trustee of a SMSF, but a lot of the time being having a corporate trustee and then the members being directors of the corporate trustee, you've got to then make sure that you've got somebody stepping in as the trustee while the husband and wife say are overseas. again, a very tricky area, and it's certainly not my specialty by any means, which is why I'll speak to somebody like Andrew in our office to make sure that those sorts of details are handled appropriately. And then I suppose an extension of what I was saying earlier too is with the foreign pension accounts, you just got to be very careful when they move back. And what I often find is people get the advice in the US. Timing of repatriation can be quite important, and often the advice, and I've had it with Switzerland, even probably UK as well. It's tricky to it is tricky to move it back, and there's no requirement that they cash in their pension funds. So I'll just leave it there, and I'll have to try and do some careful planning to avoid, adverse US tax consequences. And there are some rules around when, and we see it a lot with the UK, when you can get, if you take a lump sum pension account amount from withdrawal from an overseas pension account, it can be tax concessionally, particularly if it's done within 6 months of resuming residency. And after 6 months, it gets a bit trickier unless it's put into an Australian super fund. So there's a few, there's some quite tricky rules to navigate. But again, mostly just probably the first step is being aware that it needs planning, and then just seeking advice. I'd say I probably don't want to go too much further with that area because I'll get out of my depth really. So as I mentioned before, our HB international offices often find that we have people who they're looking for help here in Australia. We're advising they're either clients or looking for help in Australia, but they also need some overseas help. So we'll have we can get our HB officers involved in helping them with the foreign tax compliance, bringing them up to date, or just giving them advice on what they need to do. And the cross-border structuring, cross-border advice, again, we can advise them together. I've got a very good relationship with my counterpart in London, the firm there called Menzies. Menzies is the name of the firm in London, and he's a cricket tragic, which certainly helps with the discussion. We have good conversations there, and we've had calls where, for example, he's got an Aussie who's looking to come back to Australia, and in fact, that call Residency would have been relevant there because he determined that there's a certain point at which the guy would. He had some transactions to undertake, and there's a certain point at which the guy would be able to seek his UK residency. And if he spent some time on the continent before he returned to Australia, he could potentially sort of make sure the transaction happened at the right time before and there's no question in my mind that when he doesn't become an Australian resident until he actually lands back in Australia, so goes into his hotel quarantine or whatever. I mean, that's the point at which he'll be, because he's coming back for good, that's when he'll become a resident. So I don't see any issue from an Australian perspective. He's been away for long enough. So if Russell can handle the UK side of it for him, then he just needed that. So we had a Teams call with the three of us to sort of talk over that part of it. And I've got someone else who's moved to the Toronto and was doing something fairly complicated. To Canada. The HLB advisor was in Toronto, but he was also considering going to the US because he had some business interests there. Even bought a house in Kentucky and was going to do that, but then COVID put play to those plans, and so in the end, we recently had a couple of calls with together with the client and his local accountant, because we don't do his regular compliance work, we're just providing the advice. So his accountant in Sydney, ourselves, the client who's sitting in Canada, and our HLB advisor who's sitting over in Toronto there to talk through the Canadian. So that's the sort of stuff we've been able to do. Just look at the whole picture together. And sometimes people will say, well, I'll get a cold call, say, I want someone who can help me with all issues. I don't want to talk to two people in two different two different firms in two different countries. They want someone who can do the lot. It's like, well, we can't do that. I can't advise on US or UK or Swiss tax, but we've got the contacts, and I find that we can work in well together to still help the client. So that to me, that's still the best effective approach, and it works. And there's obviously other issues, legal, immigration, business, commercial issues that we have contacts. I'm sure you do as well, and we sort of help clients with those sorts of things in Australia and also obviously overseas. Because if they need local assistance, then our accounting contacts also will have those other legal and immigration contacts. All right. Well, thanks for your time.